Good morning, colleagues. My name is Richard Sherman. I'm going to be your facilitator or moderator for this morning's webinar. I'm pleased to welcome you here on behalf of the Trade and Industrial Policy Strategy, or TIPS, and the European Union. This webinar is part of a series of webinars under a program that TIPS is running with support from the EU, and we'll place in the chat the details where you can find further information. Just some quick house rules. The webinar is being recorded. We'll have a session where we have 5 speakers who will speak for, we hope, a maximum of 10 minutes each. And then we'll go into a Q&A session. And I would ask that if you have any questions or comments to the panelists, please to put them into the chat function. And when we get to that point, we'll moderate that discussion. Maybe first let me introduce myself. I work for the NDC Partnership, which is an international partnership set up after the Paris Conference of the Parties to support developing countries to design, develop, and implement their NDCs. It's an international partnership of members from those developed and developing countries, as well as international institutions and local delivery partners. We have a very interesting panel of 5 colleagues. We'll get a sense of what's happening in South Africa, what the experiences are from the European Union, and also some international perspectives from our colleagues from the International Finance Corporation. Before I go and set the context, we've had a request from our colleague Roberto Sisuti from the European Union, who would like to make some introductory remarks. So Roberto, if I could hand over to you as one of the co-sponsors of this webinar, if you wish to say a few words. Roberto.
Thank you very much, Richard, and good morning to you, and good morning also to this distinguished speakers at this event, and also to all participants. I simply want, I'm Roberto, as you said. I'm the head of the Trade and Economic section at the EU delegation here in Pretoria. And we follow, of course, also climate, environment, and energy issues. And these are important moments and important times when it comes to sustainable finance to just transition. As you might know, actually, in South Africa, in the last days, we had the climate invoice of many countries, including the EU, that have been discussing with ministries and with ESCOM and with other important players. And this is really a critical moment and conjuncture in our times to see also how we can all come together to support this just transition, which is a challenge not only in South Africa, it has been a challenge in many other countries, in Europe as well. But of course, we need to put in place also safety nets, and we need actually to get it right so that it is a just transition, socially acceptable, with the due actually financing resources that have been put on the table. And this were exactly the subject of the discussion that the climate invoice of the US, UK, France, Germany, and the EU had in these last 3 days. So coming now to these 3 webinars, Richard, you clearly said this is the first webinar of a series of 3. And these webinars are really a peer-to-peer exchange of practitioners when it comes to sustainable finance for just transition. So today, the discussion will be focused exactly on Dfi'S and concessional finance of practitioners both from South Africa and from Europe. And the next webinar later in October will be more geared at pension funds and large-scale investors operating on market terms, but over a relatively longer time frame. And the third webinar at the end of October, it's more devoted to discussions amongst commercial banks and direct lending to businesses. So I'm looking forward to the discussion of today. And I'm thanking particularly you, Richard, of course, but also TIPS, who has been an important companion in this path, but also our member states, EU member states. This webinar has been all co-organized together with our Danish, Swedish, German, and Finnish colleagues specifically. But this is a webinar which is a success of what we call the Team Europe. Europe is composed of 27 member states, 27 actually financial institutions and experiences, and we are all willing to share our experience and to learn from what is being done in South Africa with South African practitioners. I will stop here. Thank you, Richard, and look forward to an interesting discussion. Bye.
Thank you, Roberta, and welcome to the European Team Europe. We look forward to hearing the outcome of the envoys meeting. We hope that the finance can be provided as in a form that is sustainable and doesn't lead to further debt, and we can pass on the high levels of concessionality to South Africans. I was going to give a short introduction, but I don't think that's necessary. I would just say that it's important to note that on Monday, South Africa formally submitted its NDC. It's now uploaded on the UNFCCC website. We will post in the chat where you can access that. And so we look forward to the discussion today on the role of how the DFIs in South Africa can learn from their counterparties around mobilizing resources for the just transition and programming that. So with that, I'm going to hand over to our first speaker. Our first speaker is Nalini Gela. Nalini is a senior energy expert specialist at the Industrial Development Corporation, and she's going to give us a presentation on the IDC's views on the just transition. So Nalini, I will hand over to you, and just to say, colleagues, all the presentations will be made available to you, so you don't need to ask for the presentations, they will be available. So Nalini, I'll hand over to you, please go ahead.
Thank you. Can you see my screen?
Yes, we can see you. Are you going to put your presentation up?
1 second. There we go.
Perfect.
Okay. Well, good morning, everyone. Today I will be speaking to you on IDC's investment prioritization with a focus in the just energy transition. So just a quick background, the IDC is a national development finance institution established in 1940 and fully owned by the South African government. Our main activity is the provision of industrial finance to businesses throughout the business life cycle in various sectors. And we offer various funding products ranging from general debt to lines of credits. I think what's important to note is that IDC's mandate is to maximize our development impact through job-rich industrialization while contribute to an inclusive economy and funding Black-owned and empowered community companies, Black industrialists, women and youth-owned and empowered economies, basically. So moving on to the just energy transition, I think we need to understand the principles of just energy transition, more addressing the just part, which is the socioeconomic aspects and potential mitigations, together with the energy transition, which is moving from a high carbon intensive economy to the lower carbon economy. Some of the global drivers for the energy transition include stringent global environmental policy and regulatory framework, energy security, and we can see there's a rapid rise of renewables, plummeting cost of renewable energy. Another driver is the changing consumer need. So moving more into the mobility aspect, looking at electric vehicles, looking at improved electric vehicle range, as well as the convergence of energy and connectivity. So sustainability is a strategic value driver for the IDC to optimize our value offering. The IDC plays a key enabling role in the just energy transition by supporting climate industrial development and unlocking strategic opportunities for low carbon industrial development. Within the IDC, we have an energy strategic business unit that looks at funding of various energy projects with a focus more on cleaner technologies going forward. Thus far, if you look at our portfolio, and this just talks to bid window 1 to 3 in the REAP program, we have supported an investment of about 120 billion, predominantly in the solar space and the wind technology space. So what is the role of in this energy process, and what are we focusing on? From an IDC perspective, we're looking at it at a coordinated strategy view, looking at the entire value chain segment, and each aspect of the value chain is associated with a certain or particular strategic business unit within the IDC. We have a collaborative approach to enhance this value chain integration. And the overall coordination of this is also our industrial planning and project development strategic business unit. The objectives and the major outcomes of this collaborative approach and looking at throughout the value chain is to drive our mandate, and that is focus on stimulating the local and regional economy, job creation, women and youth empowerment, just to name a few. Some other outcomes, obviously, is moving towards a more greener environment and providing energy to rural communities that do not currently have access. Supporting local technology and skills development is also a key driver and a key outcome. So in terms of industry planning, the IDC is involved with the DTIC in various industry planning. And one of the key initiatives is around the energy transition and IRP. So where do we focus our funding? We've been funding a lot in the risk mitigation program, in the REAP programs, gas and energy storage. And with the recent amendment to Schedule 2 of the ERA, we see there's an uptake in the C&I space, predominantly looking at renewable, cleaner technologies. Some of the other initiatives looking at the value chain is the hydrogen economy, energy storage, and batteries. Within the IDC, we have the key priorities. So again, these key priorities are driven by what our mandate as a DFI are or is. So the key priorities include agricultural economy, automotive and new energy vehicles, steel industry, energy, which is with the green energy, green hydrogen value chain, renewable energy value chain, and the regional natural gas value chain. I think like I mentioned, it's in line with our mandate, the focus areas, but also we're looking at the green economy aspect. Some of the funding options available at the IDC, we have a number of green bonds which we manage. Recently, we had the AFD, which expired. But another example is the KfW facility. At the IDC, we're currently developing a sustainable bond framework. And the purpose of this bond framework is looking at funding instruments, again, based on a sustainability criteria. This talks very much to the just energy transition, with the just part, looking at, again, focusing on our mandate and looking at what are the impact areas we need to focus on. And some of this include job creation, youth, women empowerment, Black industrialists, to name a few. From the energy transition point of view, the scope of this framework and the fundings thereof will include looking at more renewable energy technologies, cleaner water solutions, cleaner vehicle, cleaner transportations, to name a few. So what will it take to deploy and fund the just energy transition? I think we can tap into the key lessons learned looking at the de-risking of the REAP program. In the initial bid windows, commercial banks were very hesitant to support and fund renewable projects based on the risk associated with it. So DFI stepped in. But what was found that due to the success of those initial rounds, commercial banks then came in rounds 3 going forward with good funding options. So access to blended finance in de-risking projects, establishment of partnerships and governance frameworks, government guarantees, requirement for a long-term plan. So what is required for new technologies such as the energy storage and the green hydrogen to complement the above? We need to look at early market deployment of technologies to drive economies of scale and benefits. We need to develop innovative business funding models to de-risk these new technology infrastructure. I think a key point is looking at skills development of local technical expertise, especially in the new generation technology. And coupled with that is preventing the brain drain in South Africa. Clear regulatory framework is required, and we need to drive sustainable localization. Thank you, Richard. I hand over to you.
Great. Thank you. Thank you very much, Nalini. And I think that last slide, which is the last section of lessons learned from the REIPP, is really important because it talks to the form of finance that's required to support the just transition. So thank you very much. I would just prompt you, maybe if you can answer in the chat, is there any consideration within the IDC to establish portfolio targets for it? As we know, the phasing out of fossil fuel lending is a key thing, and also portfolio targets for balancing your mitigation and adaptation portfolio. So maybe you can think about that for the discussion. Thank you very much. So now we're going to move to our next speaker, which is Chantal Naidu. Chantal is the founder and CEO of Rabia Transitions Initiative. Chantal also has a very long history in climate finance and financing in South Africa, the developing countries in general. She worked for many years at the Green Climate Fund, and she's also worked at the DBSA, and she's also one of the authors of a chapter in a new report that's coming out, we hope pretty soon, Chantal, on the biennial assessment of climate finance flows, focusing on mapping of the implementation of Article 2.1c of the Paris Agreement, which is on reliable financial flows. So Chantal, over to you.
Thank you, Richard, and thank you also to all the organizers for the invitation to share today. I haven't put together a slide presentation, but I will make my speaking notes available. I thought I'd speak just from my experiences, and as Richard has shared a little bit of that background. So where will I start? National development finance institutions, for me, always had a very idealistic role in any economy, specifically in their ability to transform government policy into investment streams that can benefit society in innumerable ways, specifically lifting the vulnerable out of poverty, creating sustainable livelihoods, and building infrastructure. And especially the counter-cyclical role they often play, which is during low growth periods, being able to buffer the reserve of private capital at that time and continuing investment in any regardless. In reality, though, based on my experiences, both with DBSA and in the Green Climate Fund, and then just observations more broadly, national DFIs are quite complex institutions. And it's quite difficult to get, quite difficult, but deeply satisfying to have investments secured, but often they're constrained from realizing their full potential. And I'd like to share a little bit of my story and understanding of the DBSA in particular. So its origins are a little bit checkered, but beginning in 1988, from its inception, my understanding of speaking with colleagues that had started in the very early days of DBSA is that the founding director of DBSA at the time, Dr. Simon Brandt, said the DBSA would be founded on knowledge. It would be a place of active debate and critical engagement on policy, and that all would be translated into very precise action. I also learned it was a place of subversion in some instances against the apartheid space in those very early days, despite it being formed largely to create separate development. So it was quite a bold and experimental institution, which aligns with the role of quite a few national DFIs. And what was fascinating for me is that the DBSA had immediately adopted the environmental and social agenda post the 1988 Brundtland Commission, which defined how we understand sustainable development. And its evolution from that time to the present moment, from a green and a perspective, involved, in addition to the safeguards, but also a desertification fund, a green fund, being very instrumental in the renewable energy IPP program, both from a program development point of view prior to the bid windows actually being opened, and also from a funding perspective, playing quite a pivotal role. And now it has its climate finance facility, and of course we know that it's accredited to the Green Climate Fund, to the Global Environment Facility, and having deployed significant funds from that perspective. So this is not a sell job for the DBSA, but it has a long way to go still, as most national development banks probably have in terms of capabilities, perhaps ambiguous agendas. But the point I want to make more is that history shows that national development finance institutions and DFIs in general, such as the DBSA and as Nalini has shared from IDC, have long been involved in transitions from in one form or the other. So moving from one development state to another. Optimistic view. Pessimistic view is that transitions might be, development failures, because if some of the elements that we're trying to grapple with now were in place and prioritized in the beginning, we might not be trying to transition back to a better environmentally and socially responsive economic pathway. So I thought I'd share then perhaps some views around the characteristics of South Africa's energy transition as I see it. And from there, I'll share what I believe might be a role, a deeper role for DFIs, and also some context around the international DFIs. So from what I see, our energy transition in South Africa, though generally headed towards clean energy, and the NDC, updated NDC indeed offers immense hope and new energy. Historically, there has been an ambiguous direction to our transition journey, which is not unsurprising, but just to acknowledge the ambiguity. There is most certainly a spoken level of urgency, but some muted action. So our short-term policies are crowding and maybe clouding as well the long-term structural shifts. So we are doing what is necessary for a short-term horizon, but there is deeper levels that might need to shift moving forward. And of course, the social contestation is immense. We have overt attention on the energy transition, but obviously there's other sectors, as Nalini has also shared in her presentation, with IDC would be involved, other infrastructure, network infrastructures that a DBSA, for example, would have to be engaged in. And some of the solution space that is being considered, it is questionable the degree to which one might be fully engaging with the affected communities and including them. I don't believe this is specific to South Africa. I believe it's actually quite a generalized comment that one's making. The fourth characteristic, as I see it, is there might be a level of trying to mostly maintain systems quo. And that's just a play on status quo. So systems quo in the sense of to what extent are the policies that are coming through reaching the level of incentivizing, actively incentivizing an exit out of unsustainable investment options and creating more sustainable options. A large part of the action at the DFI level and even this private finance level in South Africa, I would say kudos goes to the civil society in a quiet way also for their actions for directional shifts in investment policy, where we've seen 4 of our major banks make significant statements around fossil fuel investment, and also actions outside the DBSA in terms of protests and creating conversations about how can that objective be achieved, and acknowledging also from a systems perspective that we actually have quite an unjust baseline before we're trying to achieve the just transition context. I think finally on the characteristics part, before I go into the critical roles, in terms of experimentation, that's one of the roles that DFI can really play very significantly. But I guess in terms of the degree of experimentation, are we playing it safe in terms of public and private finance, in terms of looking for certainty for investment? But when transitions by their very nature are disruptive and uncertain processes, as COVID has showed, the biodiversity shocks that people predict are upon us. So what it shows is that there's probably just certainty in the fact that it's going to be an uncertain time ahead for the DFIs to help navigate. So we need quite responsive and experimental finance. So appreciating those kind of contexts, what type of roles could a DFI then play, which is much more, which may be beyond just the deployment of finance, but being a champion and a specific driver of change. To go back to the DBSA example of Dr. Simon Brandt, at the time it was, there was a critical leadership that came in and set a specific direction. And also rethinking their place in the domestic financial system. Are they complementing or competing with private sector? And to what extent, from a relational perspective, are we creating experimental finance so that that different sources of finance can blend well together in a very designed type of way, not so much by accident. The next point is around the incentives of DFIs. In countries such as Ethiopia, for example, I heard their National Development Finance Bank referred to as a policy bank. They will take government policy, they will implement it. In India, for example, DFIs apparently serve less of a counter-cyclical role, but they stand shoulder to shoulder with private sector doing fairly progressive things. And then the capital structure of DFIs actually matter, and it can either advance or constrain the ability of the DFIs to go further. The last 2 points I'd make is around the ability to make to design financial instruments from an innovative perspective that are socially inclusive. So some research that I've seen around the IPP, for example, is that the community structures around BE and social inclusivity were not necessarily that inclusive. So I guess just financial structuring is also critical. And the other aspect would be around the origination of just transition portfolios. By that, I mean, we largely understand individualized projects, but some work that TIPS itself is doing and that I've had insight to is also showing that there's actually clusters of projects that are necessary. So we don't just need to be thinking at a project level, but also portfolio. So my closing thought, I would draw from George Harrison in the Beatles song, where he says that if you don't know where you're going, then any road will get you there. So certainly from a DFI perspective that watches the space, watches the challenging space we're in, we are in increasingly volatile situations and conditions. And certainly the just transition is a concern of the moment, a social concern. But in reality, that social concern has been there for a really long time, as well as we've watched the inequality spread. Scientists have warned of immense social and biodiversity systems collapse, and the challenge is really to regenerate and discard some of those older foundations. So to my mind, DFIs are potential resilience builders, risk sharers, even drivers of essential investments, but they too need a degree of transitioning. And in that way, the relationship with the international development finance institutions can help significantly. I'm slightly over time, Richard, but if you indulge me for just a few seconds, I would say that the international finance institutions can play a strong role in how they engage with national DFIs in terms of helping to reduce fiscal burden, and that the terms and conditions of those support, what does that look like to relieve that dimension? And also, there's definitely a strong bias in terms of the instruments that are offered in terms of debt. Why might that be challenging? Because that might be a filter which prevents essential investments from happening as opposed to advancing it. And volume seems to matter as well, the big ticket investments relative to the small ones. So international and DFI, national DFI relations really truly matter. I would leave it at that, and thank you very much for the opportunity to share these perspectives.
Great, thanks Chantal, and that's okay to go over. I think you raised some really important points in that extra bit about the form of the finance. What are we actually getting? Is it going to be more debt? And how do we maximize the concessionality? I think you made a point about the DBSA being a driver of change, and I think they are. They're the first developing country DFI to have a just transition investment framework, which was adopted earlier this year. I don't know how public that is, and certainly we understand that the executive board is having consideration of the executive statement around phasing out fossil fuel lending over a period of time, and certainly they haven't, their last direct investment in coal or fossil fuels was 2015. In 2019, they did give a loan to Eskom, but that was more about, that wasn't about capital investment. So thank you very much. And also you made reference to their innovative climate finance facility, which is one of the first. We understand that's looking at local currency lending. So rather than borrowing and paying back in US dollars, you would be borrowing and lending in South African rands. And that project is with the Common Customs Union. So that rand denomination lending is being shared with certain countries. So thank you very much. I'm going to move on to our next speaker, which is Matthias. Sorry. Matthias Baldini. He's an advisor at the Center for Global Cooperation and part of the Danish Energy Agency. Matthias has been working closely with the institutions in South Africa and India and engaging with them on Danish expertise and Danish lessons. So Matthias, welcome, and we hand over to you, please. Thank you.
Thank you, Richard. And can you please confirm you see the full screen on presentation mode?
Yes, we do. Thank you.
Okay, perfect. Well, thank you all, Richard, for the introduction, and good morning all. My name is Matthias Baldini, and I work for the Danish Energy Agency. And I'm here today probably to provide a concrete case. The colleagues until now have been talking about finance and investments. That is probably a story that happened in Denmark, where policy, finance, and sustainable and just transition were combined together to have a transformation from coal to from black to green for a Danish company. This is a report that we published last month, and the idea, the general concept of the report is that there's three parts. The first one is a timeline of events. So comparing how policy enable the framework for a company to transform their asset. The second part is about the learnings, both from a policy and company perspective. And the last are recommendations based on this experience. And of course, the slides will be shared, so you will all be able to access this report. But first, the starting point is probably a timeline, starting from 1970s until 2021. It's a long period of time in which Denmark somehow developed both policies to enable the transformation of the energy sector, and a Danish company in particular called DONG, which stands for Danish Oil Natural Gas, transformed itself from being a company purely based on natural gas, oil consumption and extraction, until today, which is a company which is fully relying on renewable assets, playing not only on the Danish markets, but also in the European, US, and international. I believe that given the time available, I will not be able to explain or provide an idea of the full timeline. So I will just focus on the beginning part and on the last part. The beginning part is probably the period between the 70s and the 80s, which is probably the kickstart of this transformation that Denmark went through. In 1973, following the oil crisis, Denmark was badly hit in terms of energy supply, as it was relying mostly on oil consumption. So that was a signal for Denmark that it was time for a transformation, and steps were meant to be taken to transform the energy sector, considering, of course, the strong dependency on oil and those other countries. In parallel, while Danish politics was developing this framework, a company called DONG was merging together. So there used to be a company in natural gas, oil extraction, and transformation. All these three companies merged together to become DONG. One thing that was essential also is that when Denmark tried to transform and reduce the oil dependency, from the beginning, they said no to nuclear, thus removing nuclear also from the puzzle, and somehow creating a framework that was leaving no space, if not for renewables and other things. So energy planning was something that from the beginning was essential to understand how the system could develop. And in parallel, Dong, of course, had to understand how to fit in this framework in terms of asset and transformation. Jumping directly to today, I apologize, quite a big step in the future, but what happened to Dong, which on 1970s was purely relying on coal and oil, was that in this period of time, they divested most of the assets, they invested in renewable technologies, they changed the name. So from being Danish Oil Natural Gas, they moved to Ørsted, a Danish scientist which was working with atoms. And by divesting the oil and gas business, by jumping into joint ventures with other companies, and by selling the part related to distribution system operator, managed to focus only on renewable energy technologies. And this was possible because in parallel, the Danish government was pushing for targets, providing reliable and secure target for the company to invest in the future. So Denmark in 2020 committed to have 70% reduction in CO2 by 2030, planning energy islands and providing tenders for new offshore technologies. So this policy transformation from a government perspective enabled a company to make investments and to have secure returns in the future. Jumping to the policy side learning. So our idea was to create learning from both policy perspective and company perspective. There are 5 main policy side learnings, but I would like to start from the demonstration project. So demonstration projects on a Danish framework allowed not only to have a technology maturity, so to make sure that what was a concept at the beginning became an established technology. But this allowed also the Danish government to develop a framework, so a regulatory and policy environment where this technology could fit. And by having it in place, a regulatory framework, the company felt more sure to invest in these new technologies. What Denmark did also through the Danish Energy Agency was to create what we call a one-stop shop. So having one institution that is responsible for all the streamline of the permitting procedure. And in this way, the risks were reduced as well as the delays. So by having one-stop shop for all these developments, companies were more relying on the Danish institution. And likewise, the Danish institution could allocate some of the risk, not only on the shoulder of investors and the companies, but also on the political level. And of course, economic incentives were also essential for this transformation. At the beginning, subsidies, of course, were provided for new technologies and new framework to develop. However, what happened throughout the years was that the subsidies, taxes, and CO2 prices were discussed between the industry and the government to have a transparent development in their sector. And what all these key aspects from the policy perspective enable this Danish company called Dong to become and transform from black to green. So what happened is that the company, based on these policies agreed at government level, developed a sustainable vision. So considering all the oil and gas exploration that were available before, Ørsted or Dong divested everything. So as of today, there's no technology related to oil and natural gas within this company. The same for coal-fired thermal generation, which was accounting for 70% of the electricity generation and 25% of the EBITDA, were transformed completely. So all the coal-fired power plants were transformed to biomass. Most of the knowledge and engineer were either focused and transformed to offshore wind, or otherwise they were redistributed to other consulting companies here in Denmark. And the same they did for other parts of the company which were not totally aligned with the vision of the company. So one step at a time, Ørsted divested all these parts which were not aligning with the vision and moved to a future where everything was fitting with the strategy. All of these by being 73% state-owned at the beginning of the journey, and nowadays being 50% owned by the state. What we did then in the report was to try to provide some recommendation based on this experience. Of course, this happened in a Danish context, in a European context, and there is some contextualization to do if a similar experience should be replicated in other contexts. But if we focus on the first two, which are more from a policy and government perspective, I believe that the least is that long-term planning is essential. And not only long-term, but also a transparent approach involving all the stakeholders from the beginning. So having the industry and the government working together to provide a long-term framework, which is stable. So enables the industry also to have trust on these policies and thus invest. From a legislative perspective, also economic incentives played a big role. There was a case in which a third tender for offshore wind projects, the prices went way above the first two, simply for a matter of misalignment between the industry and the government. So the process now really involved industry from the beginning, even for setting up tenders, and the involvement for the industry was relevant. Demonstration project, of course, allowed not only the establishment of a technology, but also to create trust on the investors, which saw something growing and understood from the beginning. And of course, permitting and de-risking from the Danish government side allowed a simplification of the process and streamline. I just have 1 minute to complete. Richard, please apologize. I will go 1 minute over the schedule. From a green company perspective, what was important was also to develop a holistic vision, so a long-term and holistic vision, of course, considering the dynamic landscape of the energy sector. So CO2 prices, gas prices, oil prices, everything is fluctuating throughout the years. But it's important to consider this dynamicity within the holistic vision. When considering the exit strategy for fossil fuels, because this company, the study case based on this company, saw a company that was purely based on fossil fuels and now is on the opposite side. So what was important was, of course, to divest most of the asset available. And on this, it was absolutely paramount to have all the actors from the industry and the government agency involved from the beginning to understand how, for example, decommissioning auctions could be set up and make sure that there was full support. And on the other hand, entry strategy for renewables, of course, validating the proof of concept was essential to attract finance to new renewable energy projects, educate, align, and engage the stakeholders on this, allowed investors to jump in on joint ventures. Being a first mover on the sector, of course, made sure that now Dong is the world leader on offshore wind, but also had to go through a lot of challenges. And these mostly were solved through joint ventures. So sharing the skills with other local companies really enabled this company to grow. And last, in terms of just transition and personnel, of course, the essential part is to build from within. So using all the personnel that is currently available, retrain and create synergies between the base and also attract new talents. So that was in short the story of how a company went from black to green and how this regulatory framework enabled the transformation of this company from considering the technology, but also investments and finance sector. Thank you. And of course, you will be able to access slides and reports for more information. Richard, back to you.
Great, thank you, Mattia. I think some interesting examples there. I wanted to point out one thing, that the transition of Dong to Ørsted took 11 years, and that for a developed country like Denmark, 11 years for South Africa to make that transition, even for Eskom, may take longer, and I think we need to understand that. But I agree with you, the exit strategies and the input strategies are important, and also just to point out that we do need to have more demonstration of ideas on how to fund the just transition, particularly the social element of it. So we haven't really seen a lot of discussion around who funds the repurposing or the reskilling of workers, who funds the loss of income in the coal value chain. So I think maybe my question to all the presenters and the participants is how do we start to do that? How do we demonstrate that? I don't think it's a proof of concept because we know it has to happen and we need to do it. So thank you very much, Matthias. I'm now going to hand over to our next panelist from the European Investment Bank, Hervé Grenestia. He's the principal advisor for public sector lending in Eastern Europe, and he's going to talk to us about the EIB's experience in Ukraine and the design of the coal transition. So, Hervé, I hand over to you. Thank you.
Good morning, everybody. Can you hear me and see me well?
Yes, we can. Please go ahead.
And can you see me well too? Can you see my presentation too as well?
Yes, we can.
Perfect.
Please go ahead.
Okay. Good morning, everybody. So I'm going to talk to you about the coal transition in Ukraine. What are the challenges and what are the opportunities for us as a European player, as a European Investment Bank? Few words about, so my name is Hervé Grenestia. I work in the EIB lending department in the Eastern neighborhood. I cover, among others, Ukraine on the energy sector and on the coal transition. A few words about Ukraine. So Ukraine is is located in the Eastern Europe, and it's one of the largest country in terms of territory. It is as big as France, and the population is 42 million people. The GDP is quite low. The GDP per habitant is 5.2 times lower than the average in Central Europe. What is the EIB? The EIB is a European Investment Bank. So it means that we are a European institution. We do operations in Ukraine because we have a mandate from the European Union, and we are AAA institution, which means that we have the capacity to lend to projects with attractive financial rates. More or less, our lending volume per year is around 55 billion euro. So basically, each year we lend or we sign 55 billion euro of loans. In terms of size of country for the EIB, in terms of volume of operation, it's one of the largest country for operations outside the European Union, together with Egypt. For example, during the year of Corona, and despite the Corona crisis, we managed to sign 1 billion euro of operations in Ukraine to support the resilience. On this slide, you see the different type of EIB interventions in Ukraine. So we are a bank of infrastructure. We finance transportation. We finance energy projects. We finance, of course, renewable energy, energy efficiency, urban transportation, and also projects in what we call with high impact, like education, like microfinance, project finance, transportation, and operations. So we are quite present, and we have also some experience in terms of financing what we call the resilience infrastructure. As you know, in Ukraine, there was the Eastern Ukraine was heavily impacted due to the conflict with Russia, and we financed some projects to help and revitalize the social infrastructure through a recovery program together with the European Union. So we have some experience in terms of providing resilience, providing social infrastructure to displaced population. Now, turning to the coal transition in Ukraine. What is the coal transition in Ukraine? Where do we stand? Ukraine is an integral part of the worldwide decarbonization train. They have reaffirmed, or they have confirmed their intention to decarbonize their economy through the ratification of the Paris Climate Agreement in 2016. Different stakeholders are involved. You have the local stakeholders, regions, local governments, but also the national stakeholders and the international financing institutions. In Ukraine, essentially 5 regions are concerned by the coal transition. You have Donetsk, Dnipropetrovsk, Lviv, Luhansk, and the Volyn regions. These regions will have to face the challenges and also the changes of the decarbonization process. What is important to stress is the issue or the question is a national question, but it needs to be rolled out on a regional level. The coal sectors, on this slide, you can see who are the actors of the coal mines in Ukraine. Very simply, the big share of coal mine production is run by a private operator called DTEK. They have taken the best mines. On the state mines, you can see on one of the graphs that they represent 44% of employment for only 12% of production. So you have the bad mix of high-cost mining and a lot of state subsidies. So basically, the state mines are loss-making businesses. The social issues are very important. It's going to be difficult to replace all these jobs. We need to be clear about that. We need to be able to attract investment to create more jobs in this region, but it's going to be difficult because many of these coal mines and coal regions, except for the ones in the west, are closed, are in the proximity of the conflict zone. And also, many of these coal mines are located in what we call monotowns coal mines. So basically, everything in this town or in these cities run around the coal industry. So there are essentially 3 challenges ahead. The economic diversification, the question of the human resources and social issues, and the third one, the energy transition. How to kickstart economic diversification? So as mentioned before, most of the Ukrainian coal communities are monotowns. They are economically and socially dependent on the state for subsidies of the coal mining sectors. But at the same time, these coal communities have strength. They have a workforce which can enable to further develop decarbonization and to further develop economic success. What can we do? What should we do first? There are different action plans which can be considered. You have short-term action plan, medium-term action plan, and long-term action plan. Short-term action plan could be, for example, the mine closures. But the long-term plan could be, for example, the economic diversification, the repurposing of the lands. We need to do what we call a gap analysis. A gap analysis should demonstrate the deficits that need to be addressed to progress with the transition. What are the assets which can be adjusted and developed to foster a new economy? For example, what are the human resources available? What are their skills? What is the availability of the land? Are they rich in technical infrastructure? Is there a presence of a large industry next to the coal mine? Once it's been done, the action plan should be defined at the national level and then rolled out at the regional level. At the regional level, there should be in place some regional agency to make a list of projects which can enable a comprehensive regional development. The next challenge is what I call the human resources potential. How to unlock the human resources potential. The miners workforce, there are people who have some technical skills, but their technical skills is not in adequation with the needs of the new economic sector. So a strong focus will be on the retraining, rescaling of this competent and educated workforce to be able to find new jobs in the new economy. And the educational sector, the role which will play education will be key to lower the risk of forced migration. Training facility needs to be developed at a regional level to be close to the coal mine and close to the people. For example, in some region, especially in the Donbass region, which is close to the conflict area, this will be difficult to put in place, but because we are close to the conflict zone. But we need to do, and we still need to develop the education and the retraining there. Also, one thing which is important and what we have seen as a EU in other project, as a EU bank in other projects we have financed in the European Union, these workers can, due to their technical skills, can be easily retrained to the new economy or the new green economy or green energy sector. In fact, the presence of this coal industry should be seen as an opportunity. Its workforce and sites may be transformed and used for decarbonized business. The other thing which is very critical, not only the economic aspect, the social aspect, and the education aspect, the other aspect is what we call the urban challenge. Territorial developments, there should be some public investment to improve the quality of life of the people. So it could be some regeneration and preservation of natural environment. Some mines could be transformed and shaped into some cultural heritage site. Therefore, improving the quality of life on these three aspects to the people can lower the risk of migration and from these zones to the main cities, to the capital of Kiev. Also, if you develop cultural heritage, social housing, this may help to foster, for example, tourism and generate additional economic benefits. Concerning the how to start the energy transition. So this is the third aspect. Now, the energy transition is one of the core challenge of the coal transition. Ukraine has ambitious targets under the Paris Agreement to lower the greenhouse gas emissions. They have to reduce their emission by 65% in 2030 compared to the 1990 levels. And they plan to abandon coal by 2030. They need to find other energy powers, energy resources. Hydropower will play a critical role, but also nuclear will play a role to lower and to meet the Paris target. You have energy efficiency and also biogas production resulting from the development of the agricultural sector. Another aspect which is critical for Ukraine to be able to meet the Paris Agreement targets will be the integration of the Ukrainian electricity grid to the European system. It's a precondition to be able to meet the Paris target. Concerning specifically the coal mines and concerning the energy transition, and I will show you in the next slides, it can be an opportunity to develop cluster of green energy or innovation due to the capacity and due to the coal mines or coal industry matrix, where you have access to a power grid, where you have a workforce which has some technical skills, you have some manpower, you have some transportation. Well, different factors, different parameters, which can be used or which can be recycled to develop the development of a green and innovation sector.
Hi, sorry to interrupt you.
Yes.
Sorry, we're just running tight for time. I don't want to interrupt you, but if you can just start wrapping up, please. Thank you.
Yes, sure. What can we do as EIB? Very simply, EIB has a lot of experience in financing projects in the cold transition, in just transition, in the European Union. So one thing we can do is cross-fertilize our experience, share our knowledge of the project we have financed, especially in Poland. We have also it's financially attractive to work with the EIB. We can bring loans on long tenors together with technical assistance at financial interest rate. And then I will move together with technical assistance. I will move to the final slide, which shows examples of cold transition projects which we have done in Poland. So we try to focus exactly on the different sectors and we try to tackle the different challenges we've done concerning the cold transition. So development of social housing, urban development of certain cities, which basically we transform and reshaped a degraded industrial district to an eco-friendly and environmental friendly production and services function, including some housing. And the most interesting one, I would say, was the construction of a solar farm on reclaimed land. So basically this land, where you can see the graph, it used to be a coal mine and it has been transformed into a solar farm in Poland. So in this particular case, the workers were used not only during the construction phase, but thanks to the retraining center, which was put in place to that effect, they were able to be used and to be employed during the operation phase and during the as employers of these solar farms. And I'd like to conclude that we are now ready. The challenges of the cold transitions are there. They shouldn't be underestimated. But now we have a momentum. We have a momentum together with the European Union to turn words into real actions and to make the cold transition in Ukraine a success. Thank you.
Great, thank you very much, Hervé. That's a very interesting example. I think there's some points that you made that resonate with our experience in South Africa. One, I think you made the point that the cold transition will be difficult, but that there are opportunities both for economic opportunities and environmental opportunities. I think the points that you raised around economic diversification, one, the HR and social dimension, and then the energy transition will probably resonate very closely with all South Africans involved in the sector. I think it would be interesting maybe in the chat if you could talk to us about the costs of all this, where the EIB was providing either loans or grants, or to what extent money came from the European Commission's Just Transition Fund. And then you made a point about that they won't, the just transition, the workers will not be able to be compensated. And I wonder, again, if you could put this in the chat, whether you think that that's is a specific problem to Eastern Europe, or whether or not South Africa should be looking at finding a way to compensate their workers. So we're running a little bit late, everybody, but we have one more speaker, and that's Louise Gardner. She's the Africa coordinator of the Sustainable Banking Network at the International Finance Corporation. And because we are running a little bit late, what we will do is we've agreed that we will compensate that time by just going a little bit over the end time at 10:30, to allow for more discussion and debate. But I would encourage colleagues to please continue to put your questions in the chat. So Louise, I'll hand over to you and I will give you the full 10 minutes. So thank you very much. Please go ahead.
Thanks, Richard. Can you see my slides okay?
Yes, we can. Please go ahead.
Great, thank you. So good morning. It's a pleasure to be on this very rich and interesting webinar. So I speak from two roles within the IFC at the moment. One is working on a variety of green finance and sustainable finance advisory and technical assistance programs that are supporting the South African financial sector to move very quickly to be ready for climate finance and green finance, and that includes the transition. And I also I am the Africa coordinator and working groups coordinator for a global network that IFC facilitates we're now called the Sustainable Banking and Finance Network. As of today, I'm very pleased to announce that we're changing our name because we started out as a network in 2012 supporting financial sector regulators and banking associations focusing on sustainable banking and particularly the management of environmental and social risks. But in the last few years, the work has expanded it very quickly to include this very interesting landscape of new sustainable finance instruments, opportunities, the role of capital markets and pension funds and other parts of the financial sector. So we're now called the Sustainable Banking and Finance Network. So firstly, IFC's role in the green finance market. I think most of you are very aware of the role that we play as an investor and working with financial institutions to develop credit lines, issue green bonds, invest in renewable energy, energy efficiency, greening SMEs. So a wide range of activities that I won't go into in detail. But just to talk about IFC's commitment, as of now, we've committed to grow our climate-related investments to an annual average of 35% of our own account long-term commitment volume between 2021 and 2025. And these commitments have, this is not the first commitment, so it's been successive commitments to grow that percentage, and it's a profitable part of our business. And there's just growing enthusiasm and interest within the IFC. And as we build up expertise and develop tools, we're very eager to share that with financial institutions and help grow this collectively. So we've also, we've invested for our own volume quite significantly, and we've mobilized additional finance for climate finance. We're also one of the earliest issuers of green bonds, EIB on the call, another partner in the green bond market. We launched our green bond program in 2010, and as of June 30th this year, we've issued over $10 billion across 178 bonds in 20 currencies. That includes several in South Africa. So listing a bond on the Johannesburg Stock Exchange, but also working with financial institutions in South Africa on issuances. We've also been very active in the International Capital Markets Association, currently chair of the Green Bond Principles Executive Committee, and we collaborate with other international finance institutions on impact reporting harmonization. We've developed several taxonomies of our own to guide our investments, and we're very interested in the global work on taxonomy development that's increasingly moving towards convergence. Through the Sustainable Banking and Finance Network, which I represent, we're also the Secretariat for a global knowledge sharing network for financial sector regulators and banking associations, capital markets regulators, ministries of environment, ministries of finance across emerging markets. These are all institutions that are very committed to transforming their financial sectors to reduce environmental and social risks. So firstly, looking at environmental and social risk as something that affects financial stability, and then looking at the opportunities, significant opportunities for green and sustainability focused finance. Also a big focus on social. And I think that's what's quite critical, is that we have 43 member countries, 63 institutions representing 86% of banking assets in emerging markets. 33 of those countries have launched actually over 100 policies and principles now to facilitate sustainable finance, both the risk management side and the opportunity side. And one of the repeated themes is you can't do environment without thinking about social and the people. And so this question of transition is top of mind. There's also a big emphasis on financial inclusion, inclusion of women. So this is a very interesting network of financial sector regulators and industry associations collaborating to redefine the landscape for sustainable finance. And thanks to these experiences, we have a methodology and a roadmap for assessing and benchmarking these countries. Our 2021 Global Progress Report will be published at the end of October, and it's the most comprehensive benchmarking of national initiatives on sustainable finance. And I think very briefly, to give you a sense of the topics that are covered, you'll see there are 3 pillars in the bottom left-hand corner: ESG integration, climate risk management, and financing sustainability. These are the top priorities identified by members. This is where they do their work. So they look at how to help the financial sector to manage risk. So that would then include risks to people and the environment related to coal. And then climate risk management is a new pillar which responds to expectations through the Task Force on Climate-Related Financial Disclosures, the Network for Greening the Financial System, where the financial sector is moving quite rapidly to figure out how to assess risk. Central banks are playing a big role in that. And we're seeing a lot of tools and innovation coming out. So our members wanted guidance on that. And then financing sustainability reflects the very quickly evolving landscape of instruments, frameworks, taxonomies that are helping to facilitate sustainable investment in sustainability-focused sectors. And the result of this type of collaboration, to give you a sense of the impact, we looked at the cumulative green bond markets at the end of 2020, and we saw that in most regions, including Africa and Latin America, the members of the Sustainable Banking and Finance Network are responsible for almost 100% of the issuance of green bonds in those markets. And we definitely see a link between creating the enabling frameworks for this work and then the result in terms of issuance and more capital going to green finance. Places like China, which have led the charge, also have now very detailed data on the link between green lending and lower credit risk, lower non-performing loans. So this is robust multi-year data, which is showing there's a real benefit to banks from doing this work. So then I think a key thing for me to share today is, out of all these various activities within the South African market, we're about to embark on a very exciting collaboration between the IFC, the Sustainable Banking Finance Network, the World Bank, which is doing pioneering work in helping central banks to develop skills on assessing climate risk and doing scenarios and stress testing, and then how to provide enabling frameworks for the financial sector, and supported by the Renewables Academy in Germany to provide capacity building to the sector. So this is a very unique IFC World Bank collaboration over the next 5 years within South Africa to support various parts of the sector. South Africa is one of 4 countries chosen. The others are Mexico, Egypt, and Philippines. And South Africa was selected because of the work already done in South Africa by stakeholders and other development institutions, including those on the call today, to support this work going forward. So what will it aim to do? To increase the understanding of climate finance opportunities and climate-related risks. As we know, particularly on the risk assessment side, there's a lot of work that's being done and knowledge that needs to be built. To help guide consistent and policies and incentives for climate finance that are aligned with the NDC, build capacity, increase the availability of long-term financial resources for this work from IFC as well as other lenders, and then to make sure that the financial sector have all the tools they need to experiment with the new financial products. The program aims to reduce. It's called 30 by 30 zero for South Africa. Its main objectives are to reduce coal exposure to as close to zero as possible. And that's based on targets that the banks, we will work with banks and they will choose the targets that are most appropriate for them. But our goal is to reduce as close to zero as possible by 2030 and to increase the percentage of green lending by banks by 2027. So that I think speaks to how do you help banks figure out how to reduce their exposure and shift towards more green investments. And IFC will play a role as an investor, so we'll be working on the advisory side, but we want to benefit along with other investors that will be able to come in and capitalize on the new climate investments. IFC has estimated around 23 trillion or more in investment opportunities in climate-related areas over the next decade, and in South Africa, $588 billion of investment. So there's massive opportunities. We just need to remove the barriers. And so these are the components of the 30x30 program. The World Bank will focus on the regulation side, working with the Reserve Bank, the Prudential Authority, the National Treasury, to build up skills in climate risk management and work being done on enabling frameworks. IFC is already supporting National Treasury in the development of a green finance taxonomy. I want to just acknowledge our donors who make that possible. So it's SECO, the Swiss State Secretariat for Economic Affairs, and then SIDA, the Swedish International Development Agency. We also have support from Luxembourg and the Netherlands. So we work with European donors to make this work possible. So we're looking forward to the Green Finance Taxonomy, with which National Treasury will launch in the near future. We've also worked, supported with GIZ, we've supported the work of a Sustainable Finance Instruments Working Group chaired by the JSE under the Climate Risk Forum, led by National Treasury and the Banking Association South Africa, to develop a Sustainable Finance Handbook for South Africa. That draft is available if anyone's interested, and will be published in the final version in the near future. And in 2020, we did work with the Financial Sector Conduct Authority. This was IFC, again, supported by donors, supporting the Financial Sector Conduct Authority to assess climate risk capacity and exposure within pension funds and willingness to move towards green lending. So there's definitely interest from the pension funds there, but what they're lacking is investable pipeline and clear definitions of green finance. So through the 30x30 program, which is the pie in the middle there, you'll see the 4 components. We'll be working with the regulators. So the World Bank will work with the regulators. IFC will be working in the capital market space and with banks and pension funds. And then our climate development, business development department will be looking specifically at the agricultural sector and how to remove barriers and create supporting tools and possibly contribute to supporting policies to enable climate smart investment in the agricultural sector. And a quick snapshot of where the World Bank work will focus. It's helping South Africa's financial sector to adjust to the physical risks as well as the transition risks associated with the climate change scenarios. And then on the banking side, we'll be working closely with banks. To be honest, South African banks are quite advanced on this. And so I think it's identifying, where are they interested in additional support in terms of tracking, carbon accounting. But I think there's particular interest around pipeline development and products, new products around sustainable finance. And this is where we'll be kind of running as partners with these banks over the coming years to accelerate this work. And these are the kinds of themes: renewable energy, energy efficiency, climate smart agri, green buildings, and green bonds and climate thematic bonds. Thank you. If there are any questions, we'd be very willing to respond. And this is meant to be a collaborative initiative. There's so much being done, not just by IFC, but other development finance institutions and donors. And I think the EU is playing a very strong role, particularly leveraging the work being done on the EU Sustainable Finance Taxonomy and disclosure requirements. So there's quite a bit of knowledge sharing to be had from the European Union. So thank you to EU colleagues. But the work that IFC and the World Bank are doing, we're very open to collaboration with other initiatives in South Africa. Thank you.
Right, thank you very much, Louise. That's a very interesting presentation. See what the IFC and the bank and other MTBs are doing in South Africa. I think you made an important mention of supporting the transition risk in South Africa, which is large. The creation of investment pipelines. We hope the new targets in the NDC will facilitate that ambition. I would assume the 500 million that will be provided by by 2027 would also include more leveraged or mobilized finance. So I'm not quite sure exactly what the IFC is leveraging, but I would assume it's in between 1 to 3 or 1 to 4. So that's actually quite a substantial amount of money that supports our NDC financing goals. I guess I probably speak for everybody here that we look forward to the outcomes and the work of the 30x30 program. Very interesting. really happy that you made mention of the importance of financial inclusion, in particular of women, because I think that often gets left out. Sometimes the climate sector is so focused on one thing, they forget about what's happening next to them. So that's really important. So, and then finally, I think that the point that you made that you can't see the environment without people is, again, a very core element of South Africa's just transition that it needs to be. I think Saul, the head of TRIPS, has made the point that the transition has to be just. It's not just the purpose of a transition. So thank you very much. So colleagues, we're running 5 minutes late, and we wanted to have some time for a bit of a discussion. There have been some questions in the Q&A. I hope that colleagues that ask questions that have had your questions answered satisfactorily. So if everybody indulges me, I will give you another 10 to 15 minutes maximum for any additional questions. So I guess if you want to ask any questions, please direct. You can raise your, just put it in the chat that you wish to speak. Maybe you can also say which panelists you want to ask a question towards, and then once the technical facilitators give you the floor, maybe you can just briefly introduce yourself and then ask your question. So please, if you wish to raise a question, please put in the chat that you wish to speak, and the technical colleagues will give you access to the floor. Thank you. And I think Louise is sending the links to the Sustainable Finance Handbook and the taxonomy also in the chat. So colleagues, if there, I see you. No more questions? Anybody? So there are some questions. Louise, there's a question for you in the chat around Harris would like to know about more about investments and funding in South Africa. And he's also, I think the contact details, Harris, were in the presentation that we shared with you. Okay.
I can share our contact details. So in terms of the investment strategy on green finance in South Africa, the person to contact would be my colleague Dio Onyango, the green finance specialist in our Johannesburg office.
Okay, great. Thanks. Okay, so then nobody wants to prompt any questions. Maybe I'm going to start picking on people. Are there any colleagues from the Presidential Climate Commission still on the call that want to ask a question? No. Okay. So nobody seems to be wanting to ask any questions. So then I'm going to wrap up. So let me first thank TIPS and the European Union in South Africa for organizing this webinar. Let me thank all the colleagues who were joint presenters. Thank you very much for your time and for sharing your experiences. As we said, colleagues, we will make the presentations available. And if there are any further questions, you can direct them to the colleagues at TIPS. So with that, I don't know if my colleague Roberta from the European Union wants to say any closing remarks or thank you. But if not, Roberta, then let me close this webinar and thank you all for your time. And I hope it was an interesting discussion, and that I hope we all left here with some useful insights. And I wish you all a good day. Thank you very much. Goodbye.